Hello there. In the studio once again, I'm joined by Credit Suisse Director Herve Prettre as we take a look at the outlook for 2013. Herve, thank you very much for being in the studio once again.
Thank you.
Overall, 2012 has been a harder than expected year for some traders and investors. Would you agree with that?
Not really. It has been a surprising year in terms of returns. Look at equities. Nobody would expect the equity market to have this kind of positive performance. Credit is still doing very well. So it was expected to be worse. So actually at the end of the year it was not that bad. True, many investors did not participate, particularly the equity market rally, as many investors are still underweight equities, but we can't say that the year was as bad as expected.
But let's focus on Europe in particular at the moment. You know, we've had Spain, Greece, Ireland, Portugal, all in the news this year for the wrong reasons, all in the headlines for the wrong reasons. What's your outlook for the euro area as we move into January 2013? Is it still going to have that? It's still going to be negative, surely?
Yeah, we have some. Europe will have an economic growth below capacity. We don't expect a recession for next year. We had a minus 0.4% economic growth forecast for 2012. However, for 2013, we expect a positive 0.2%, so basically flat. But actually, we estimate that much of the euro crisis has been settled. I'm not saying that we're out of the woods, but a lot of big risk have been reduced. Look at all the programs, the OMT, the VLTRO. Some schemes have been implemented to try to resolve the crisis, at the expense of economic growth, of course, with all those tightening measures from countries. So we expect, of course, much social unrest to continue due to the heavy pressure, very weak economic growth and recession in many Southern Europe countries. Contagion of this recession to Northern Europe countries. Look at Germany, the German Bundesbank, which reduced its GDP growth for Germany in 2013. And somehow, of course, political risk and concern will not disappear from one day to the other. But overall, we don't expect the euro to break up in 2013, and we expect a flat economic growth. So not good, but not that bad either. And
better than this year, better than 2012. Some analysts, Herve, have pointed to the second half of next year being a lot better than obviously the first half and perhaps the entire year in 2012. How do you feel about that? Do you agree with that?
If you take, for instance, France, the risks on France are not going to be immediate. That's more likely as long as we move into the year and the government realizes that its 0.5 economic growth will not be met. Therefore, they will be short of the target tax revenues to meet their budget forecast. That might more happen in the second half of the year. So really, we can't say. Risks are there. We'll have a volatile year, definitely. But in terms of seasonality, it's too hard to tell.
And briefly, the euro?
Well, we have Credit Suisse has a 1.35 price target in 12 months against the US dollar and 1.24 against the Swiss franc. As you see, we estimate the euro will recover as the risk perceived by the outside world about a euro breakup, euro ending up in political strife will diminish as politicians have taken the necessary measures to avoid any breakup. And actually, if you look at the money flows, Europe has started again to meet with inflows of investment, particularly, of course, in German equities mostly, but still overall Europe has a positive inflow. So as a result, many investors from outside Europe will likely be more relieved along 2013 that the euro will not disappear, that Europe will not break up. Therefore, our slightly positive price target on the euro against the US dollar.
Herve, thank you for your assessment there of the euro area and the euro going into 2013. Before you go, though, there's one last question I have to ask you, which is the Dukascopy question. If you had $1 million where would you invest it in? We've got a selection here in the back. We've got real estate, equity, bonds, gold, cash or oil. If you had $1 million right now, where would you put it?
Do I have one choice or can I diversify my portfolio?
Preferably one choice, but I'm happy to hear your second and third choices as well.
Okay. No, basically I would definitely put it in equity. We have on the S&P 500 a 1,550 price target at the end of 2013, leaving somehow somehow 10% upside. We are slightly positive on credit, however, the return should be lower than when we expected in 2012. Real estate, depending on which kind of real estate you're talking about. If we talk about Spain or the United States, we are quite positive on US real estate. Gold, we have a 1,850 price target, so another upside. As you see, we have in your selection several asset classes where we see higher prices in 12 months than now. However, equities are likely to be for the moment the asset class where we see the most upside.
Okay, so primarily equities, but
exactly.
Real estate in there as well.
It's rather by default equities because they're cheap compared to bonds, because interest rates are low, liquidity is likely to remain plentiful, and actually companies in our view have some margin, have some scope to further increase their profit margins because of tame commodities prices and likely further pressure on salaries, enabling companies to extend their profit margins.
Thank you, Herve. A pleasure as always to have you back in the studio.
Thank you.
That's all from Dukascopy TV today. Stay with us though. Throughout the day, we'll be bringing you further updates and interviews. But for now, goodbye.